This is an ongoing research project with the Athina, who is the research fellow in the Center for Global Finance here at SOAS, and she's here in the audience. The paper was provoked by an earlier presentation we made at a group that comprised the Bank of England and what amounts like the shadow monetary policy committee that was looking at the upsurge in global money growth following COVID-19 and various responses. And we thought we should then address the question that may be keeping central bank governors in developing countries awake. That is how central banks in developing countries will react to the current upsurge in global money growth. And basically, it is very much rudimentary work, ongoing discussion. We think that by having a preliminary seminar and discussion with colleagues, we can be able to then to refocus the completion of the paper. And so we take a traditional route map that will have an introduction and explaining the motivation of this work. And also looking at the EU and UK experience in terms of the COVID-19 experience of QA and how it has translated into global money growth, and then of course the scale of further inflation. We look at the theory, and we look at a plausible empirical model, and then we do some, regional analysis, and then some of the tentative observations, conclusions that are still tentative in the sense that they are pending further econometric work. So to start off the discussion, we need to cast back and look at the developments globally at the outbreak of the COVID-19 pandemic. And the starting point we can put to around March 2020, and the economic shutdown that for immediately in March 2020, and the various responses by governments all over the world. The immediate response was in good, with good intentions, of course, and almost every government in the world was thinking of how to rescue and putting together packages for businesses and households. And in particular, we note that the US Federal Reserve announced a quantitative easing plan of over 700 billion. And then 3 months later, in June 2020, the Fed extended this program, committing to buy at least $80 billion a month in treasuries and $40 billion in mortgage-backed securities. And a year later, slightly over a year later, in November 2021, then the Fed began reducing its pace of asset purchase by $10 billion in treasuries and $5 billion in those guarantees mortgage-backed securities. So here is then a sustained, at least from the US, and US being able to influence global developments in finance, a sustained increase in quantitative easing of a magnitude that was not what had been unknown before. And we could take any indicator, we could take any monetary indicator, we could take any financial indicator. What you see is really the upsurge in money growth. And in here, if you look at the money, this is a curve of a money supply, M2, and in terms of billions of dollars, monthly seasonal adjusted, running from 2012 to 2022, and you can see the rapid growth and the steep jump around the outbreak 2020 March, and then a steep increase thereafter. But you can see that the U.S. economy remains, hot, and even if you look at it in terms of the rent of primary residences in the U.S. cities, on average monthly season adjusted, you can see that CPI that takes into account rentals or mortgages again shot up dramatically. And well, what this leading to is with the growth in the quantitative easing, increase in quantitative easing, the upsurge in a money growth. And then you find that inflation, which possibly at the which say had been so low, globally for quite some time. But you see then at the start of about 2020, the steep increase at this end of the curve, shooting upwards dramatically. And it's this part that basically we are trying to capture. Inflation all of a sudden rising after a stable period of more than 10 years globally, and trying again to rise and become a problem that had long been forgotten before the outbreak of COVID-19. And this is the interesting story that we are trying to uncover here and try to investigate. It's not only the US experience here. I think that if we look at, say, for example, the EU experience, you find that the European Central Bank response to COVID-19 also included some amount of expansion of the balance sheet. And what is printed here is basically in blue, the lending to Euro area credit institutions, and then also the securities of ECB. And here is a phenomenal increase, even if you wanted to go back to say 2000, and possibly stable developments in these indicators. And basically the growth starts phenomenally about 2020 with the outbreak of COVID-19. Expansion phenomenally of ECB balance sheets. We also capture here that it's not only the US and the European Central Bank, but what about the UK experience? And here is to capture some bits of quantitative easing in the UK, specifically in terms of the Bank of England purchases of bonds in billion pounds. What is phenomenal here is that, there is stable growth from 2009, 3 years later, 2012, 4 years later, 2016, at 445 billion pounds, and then again a bit stable to about, say, in March 2020, you see 649, and then abrupt jump in June 2020, only 3 months later, and then again a phenomenal growth to 895. So basically, almost doubling this amount in a very short time. And these three pillars here, these three bars, are associated with the outbreak of COVID and the quantitative easing response to COVID in terms of the Bank of England purchases of bonds. So in all, what we have is that taking the experience of the US, the experience of the EU, the experience of the UK, there is a greater participating, a greater growth in quantitative easing, packages to support businesses and households, and then of course the upsurge in money growth, and in the case we see in the US, again the rise in the inflationary fire that had long been taken for granted, at least in the extent of the last 10 years. What we need to do here is possibly revisit some of the theories that were able to capture this. But you see, as you know, in terms of economic theory, there are all the contending theories of that were underpinning inflation or dramatic change in prices. But we are looking for a theoretical framework that could be able to capture the quantitative easing, the upsurge in money growth, and then, of course, the supply side constraints. Because at the same time, when the quantitative easing was on the increase on the global level, and there was an upsurge in money growth in the OECD as well as, of course, all developing countries. At that time, there was economic shutdown. And economic shutdown involves, of course, the shutdown in production, a shutdown in services, a lockdown of individuals, and businesses actually closing the door, almost the hotel industry being wiped out, but also productions of goods and services and the growth of exports and imports shrinking. So there is some amount of supply side. So that while we can look at the expansion in money growth to be able to say create some aggregate demand pressures, we also need to take into account the economic shutdown and supply side effects. And so that basically from a production function, from labor markets being distorted and individuals being able, if they can't work from home, they may not be able to work at all. And that we need also to look at how the aggregate supply is shaped by this, and basically to think of that the prices are determined not necessarily on the aggregate demand side, but prices determined on the supply side, the so-called Cavallo effect, and following a paper of mine in 2021 on the changes in price determination and the changes, of course, the supply side story of price determination. But these stories in theory also need to take into account expectations, okay? And maybe in a way, both, you could look at it in terms of the adaptive expectations by being able to revise expectations continuously, also in terms of the rational expectations that basically you see economic agents responding very quickly to take into account expectation that with this money growth and with the lockdown, economic shutdown, and production constraints, there may be a high inflation expectations. Of course, the price component that stems from commodities, as we demonstrated recently in a paper with the Francois Botiano and Yusuf Somari and myself, is that commodity prices play an important role. This is just to consider the one of the new ways of looking at especially prices and exchange rates, but we also take that into account in theory in a main way. So basically, this kind of supply side determination of prices basically starts with a simple specification whereby we just postulate that production in the short run is a function of total labor inputs, the availability of loans for working capital, and of course imported material. And of course, all these suffered during COVID-19 and the economic shutdown with the labor, some of it being closed during the lockdown, and of course, the availability of loans here may be that firms were only allowed packages to keep them going, but not necessarily to easy to borrow for production. And of course, the impact on international trade that may have affected the availability and the timely availability of imported inputs, and therefore affecting the timely production processes. So if you start with a simple production function that takes into account all this, you find basically that you can start with a framework that can be able to pin down how production occurs. And of course, these are short-run theoretical foundations. So in the short run, we assume, of course, the fixed capital in the production function. And therefore, we can say that basically the response of the parameters will be less than 1. We can extend this, theoretical framework to consider that the short run then aggregate supply function, in which prices are determined on the aggregate supply side, will include a number of parameters, both that will include capture all these a variable that we have been looking at. And so in all, the real theoretical framework includes 3 elements or 3 steps. One is starting with the production function labor market to derive basically how the aggregate supply looks like. And then taking into account on the aggregate demand, we have a modified version of an ISLM specification that basically takes into account the government budget constraint. It's through the government budget constraint basically that captures quantitative easing. So quantitative easing is captured in terms of the government budget constraint. And that if you actually integrate that into the solutions, you can be able to get a aggregate supply in which the aggregate supply curve that takes into account the determination of prices, but also takes into account the money market and the government budget constraint solved through quantitative easing. You can have aggregate demand on which output is determined on the aggregate demand. This is kind of non-conventional, a twist of the non-conventional, and possible an extension of the standard Cavallo effect. And then, of course, you can have the exchange rate, which is external sector, because we are looking at economies in which basically we have flexible exchange rate specifications, in which basically is the exchange rate rather than foreign reserves that we can determine the external side of the economy. So basically what we're solving for is the supply side of the economy, the aggregate demand of the economy, and the external side of the economy. And we can actually configure this in the theory in terms of each of the single equations. So in terms of the single equation, you basically you have the aggregate demand, you have the aggregate supply, and then you have the external sector or the exchange rate. And in terms of system-wide, the system-wide give us basically the comparative statics, the change that would occur. So that basically when you start, say, the configuration of the initial curves have an equilibrium at E, and then because of the changes, over time, the changes allow the comparator to move to another equilibrium E star. When it does, you're working within 2 parameters. One is basically the domestic prices. That's where inflation is on the supply side. And then the output. It's the output and the domestic prices that is a concern. And basically what to generate from the this discussion, at least in theory, from quantitative easing, upsurge in money growth, and then contraction in output, as well as the production function and labor markets. What you get is basically a result that ends with the initial equilibrium at E, and then the final equilibrium at the comparative static at E star, whereby basically output has contracted and inflation has gone up and prices have gone up. And this is like a stagflational effect that arises from the initial quantitative easing. So the prediction here would be that basically you gain a stagflational economy, and that's why we predict that's where we are going, in the stagflational effects, whereby prices will go up and output will contract, at least initially, in the short run effect. Okay. So if this occurs in, say, single economies, how will, say, inflation that arises in these economies be passed on or spread from OECD to developing countries? We're aware that the developing countries themselves will be also in the same post-COVID-19 environment, whereby there was some amount of quantitative easing, maybe not as high as in the US, EU, and UK as we saw, but some extent. And therefore, in theory, we need to take into account both the demand channel and the supply channel. But in addition, this is the second part of the third component, to encompass the exchange pass-through effects. Okay, that this inflation in OECD countries goes through just pass on into the domestic economy through changes in the exchange rate. We also need to take into account the inflation expectations, okay, at the global level. Companies, investors, consumers draw on their deposits and boost spending, while banks increase lending, and the global economy reopens as the global economy reopens COVID-19, and it may cause demand to grow at a faster rate than economic production, pushing up prices higher. Okay, and of course, it is the commodity price which are there as a control in the very sense, because commodity prices have been known to be a conduit for spreading global inflation to developing countries. So that's a theoretical context that we put down to underpin these developments that started with the quantitative easing in March 2020 after economic shutdown. Now, so these when these equations, when they are solved, they can generate three equations. Were pinned in the behind the diagram, the comparative statistic diagram, and we have two choices. One, we can estimate the three equations of the system so that we can see how inflation interacts with the production and also with the exchange rate. Or we can just initially single out the, these are the single equation effect. We can single out the changes in prices and see how the prices change. In this simple specification, basically, that sum up the mathematical solutions that we been working through, we end up with the change in prices. Okay, remember this is the prices are determined on the supply side, on the aggregate supply side. And then we pick up the component of inflation inertia. The inflation inertia is the basically the way inflation is changing from the previous changes in inflation, and say how this inertia has been building up and is bound to increase, as we can see from the projections in price changes overall. And then, of course, also taking into account the output gap, basically whereby you are looking for changes in output that deviating from a common trend. Okay, so the trend is just a normal growth. So if you deviate from a common trend, in other words, you capture an inflation gap, which is to capture econometrically by running output on a linear trend or even a quadratic trend, and then saving the residuals that will represent the output gap. And then we also capture the excessive money growth, the upsurge in money growth that underpinning the story that we are trying to uncover here. And then you also include the exchange rate that will capture some of the exchange, the pass-through effects, and then changes in many other parameters. And then you have some of the shocks, the shocks, the standard shocks, more or less in control, basically control, that we expect that these shocks are important. Firstly, the shock from the import prices, which can also be a conduit for global money inflation to developed countries. And then, of course, you have the shock from food prices. That's the FP here, you see for the shock. And then you have the shock also in oil prices. And we capture these shocks, the three main shocks that feature in the literature. And some of these, we in the specification we are working on is to decompose this into the import prices, because you have the as included, as mentioned earlier in the production function, we have the imported inputs into the production function, especially for almost all the developing countries. But then we also have commodities through the commodity cycle approach, so we can decompose this to be able to capture both the components. And so initially, I say that we still very much are working on the empirical model, and maybe we will first, when we discuss the observation in developments at the regional basis, we can then go back to see risk specification. Because we started with just taking a sample of some of the countries that had very high quality uninterrupted data. When we started this exercise, we basically intended to have all countries in the world, and then scientifically derive a sample based on a non-availability of data, and then also be able to put together a global sample and then see the interaction between OECD countries and the rest of the world, and also be able to do some regional regressions, calling upon the seemingly unrelated regressions that can be able to estimate the same model on various groups of countries, and therefore disentangle the effects of a single variable, like, for example, exchange rates or import prices or money supply growth from across the regions. That is, we're still working on this. We haven't concluded it. I think that's where we'll be going next. But so for this time start, we have quite a couple of countries, and we are using the EMAI's database, also comparing also with the World Bank global database on inflation, especially the capture of the trends after 2020. And our initial regression, actually initial run regression, in which we intend to capture as per the, we have the output gap, captured, and the output gap actually in terms of how this responds to inflation. And then we have the excess money, money supply growth. And we find that that's important actually in Korea and the Czech Republic, but not necessarily on every economy. And maybe we experiment with all the other possible measures of money supply, especially those that would pin down how the supply of money derives from the government budget constraint, and therefore the quantitative easing transmission into domestic money. The exchange rate, but not necessarily very important. We find also the sale that happens in import prices at the transmission channel. But we find much more importantly that there is some inflationary inertia that is building up in some of the countries in our sample. While we work with the empirical specification and trying to see whether we can get patterns across the regions, we wanted to take an excursion into what is happening actually on a regional basis. If we look at recent data, so at least this is a little bit anecdotal, but it gives us an insight, and maybe an insight on which basis we can interpret our results, in addition, of course, to interpreting the results in view of the theoretical framework that we have put in place, which we just discussed. Okay, the first interest is to look at what is happening as on the African continent, looking at the CPI change over the previous year for 2021 into 2022 and for 2021, and basically capturing the experience associated with the outbreak of COVID-19. It is relevant to say that although inflation had been a problem in many African countries, say in the 70s, 18, and some ways in the 80s, the practices, especially the inflation targeting regimes that many central banks in Africa adopted, helped a great way in being able to cope with inflation. That at the time of the outbreak of COVID-19, inflation was no longer a headache for many central banks in Africa. Now, what we see here is, basically, we are concerned here with anything above 8%. And you see that this change in some countries had not been able to do 8%. But with the some of the countries, you get 15.73, that's exceptional, and 9.97. So yes, I think there is some inflationary fire building up, at least experience that the levels of the CPI change over the previous year of 2021 are greater than the years before the outbreak of inflation. And we also try to see what the reports indicate in terms of what are the main factors that associated with this inflation. Our empirical base will be trying to establish this. There is mention of food prices, which are captured in our model, and maybe looking at categories of food prices will be one of the main observations. Energy prices, and the energy price factor, of course, has now become fundamentally important since the Russia-Ukraine war. Yeah, that's possibly going to emerge and capture a different story in combination with the COVID-19. And what is phenomenally interesting, at least in the current projections, here we are looking at the projections from the Bloomberg Analytics, which we are using for the granular data. We see that the contribution of food in the CPI of some African countries is well over 40%, which is huge, even where we capture here in this chart some of the countries, Angola, Mozambique, Congo Republic, South Africa. The Angola, of course, has already been very high, but here it becomes phenomenally, say, if we are looking at the time of 2021, that takes into account the period immediately after the outbreak of COVID-19. But also we find that exchange rate depreciation has been a major factor, and I think one of these is Ghana here when you for a complete jump. So this is a way, in a way, justifies our inclusion of the exchange rate variable in our empirical specification, and basically we try to see the changes in the coefficients when we take the African sample, or even way to group the African countries into various groups. For example, oil versus non-oil, middle income versus low income. That will give us a special insight into the behavior of these economies. But also, I think we try to capture how central banks are responding in terms of the policy response, how they're responding, the fact that inflation, and to take into account the point that, with the exception of South Africa, few central banks have strict inflation targets, and because of, not only because of the cost push, but although I think most central banks had already put up frameworks and had operational models for be able to implement inflation targets. And I think the dilemma that these central banks will be facing would be looking at controlling the cost of higher inflation to the economy, and of course versus fighting inflation and inducing some amount of recession. Because the unique story, as captured by the theory, is that the theory is predicting a stagflation. And therefore, and that's a very nasty kind of a combination of high prices and contraction output, difficult to work on. And it appears that most central banks have opted for the second option, which is just to fight inflation, and even if it is at the expense of a reduction in output. But in general, one could say that the monetary policy responses and the monetary policy decisions will not be homogeneous. They will expect a high degree of heterogeneity to reflect the considerable country heterogeneity on the continent. We have, say, for example, whereby recently the policy rate is going up, Angola, Ghana, Lesotho, Mozambique, South Africa, Zambia, Zimbabwe, and where the policy rate is going down, Congo Republic, Liberia, Seychelles. This is just in terms of real-time developments of how the central banks are responding, this, even when the empirical parameters of what is happening are not yet clear. Now, we took an excursion and also looked at another important region where historical inflation fires had been experienced. Latin America was exceptionally important, and I know there are good friends and colleagues in the audience here who are watching Chile and other economies in terms of how inflation is going up. But this is the interesting aspect in terms of the consumer inflation. You know, basically you have a below zero, okay, and that of course could be interpreted also to implications for interest rates. You had below zero, like inflation, you know, up to say the outbreak of 2020, and then all of a sudden after the COVID outbreak, it shoots through and reaching almost 9% in 2022. This is phenomenal growth in CPI, consumer inflation, you know, going up dramatically following the outbreak of COVID-19 at the regional level. There's been some responses in the Latin America region, including, you know, fiscal stimulus at first, you know, of course, associated with the QE, but there appears to be no remaining fiscal space. And so they are taking some of the countries mentioned here, including Chile, Uruguay, Peru, Panama. You find a mix of some of these responses, including boosting tax rates for contracting the aggregate demand, strengthening tax enforcement, decreasing COVID-19 spending. But the truth is that basically some economic indicators have been affected, in particular the exchange rate, involving currency depreciation in the region. And then, of course, the fiscal discipline is still difficult to implement of the QE. So some of these fiscal deficits are still running in 2022. Now, looking at the theory and also the huge econometric work we are embarked in and going to explain in all directions, we also looked at what are the experiences on the ground in Asia, it's true that the CPI average has remained on target in 2021, monetary policy has also remained supportive. If you take the major economies, China, Mongolia, Philippines, Indonesia, Thailand, Malaysia, yeah, you will find that you know, basically the policy rate has been almost flat all the time. Yeah, but possibly that will not remain the same. And of course, the core inflation has started to go up in some countries, and therefore I think the fact that the experience in Asia Pacific differs substantially from the experience in Africa and the experience in the Latin America and the Caribbean suggests that it would be meaningful to actually do the modeling and the exploration of the empirical inflation specification, empirical specification for inflation slightly differently because of the sharp differences in the current experiences. Because in a way, there are some reflections of the changes in energy prices, in food prices, consistent with the observation in some African countries, that inflation has been above target, but that's already been experienced in Thailand and Mongolia, and that some of the countries have already gone ahead, including Indonesia and Malaysia, to start price stabilizing measures, especially including on food prices. And as you can see, the issue of food prices seems to be reflected in the three continents. And that's why, in our empirical specification, you can see we're also tracking about the food price shock in try to understand the changes in food prices. I think the numbers will tell, and especially the differences in elasticities, and the stability of elasticities will be very important to drive home this story. So I just want to pause here a little bit, because basically one extension in this area will try to see whether the experiences and the observations and the changes in numbers and how they tally with the theoretical framework we are developing. And that even if we looked at the developing countries, we are concerned about the transmission to developing countries and how the central banks in developing countries will manage the process. So that's why it's absolutely important to look at these changes and try to see whether the indicators we have captured here in the changes in the regions in Africa, in Asia and Latin America are actually represented in the theoretical derivation of the model, which runs to about 6 equations. So we didn't put the solutions of the model in the paper, but they are in the paper. And secondly, whether these observations in the way the numbers are coming up in the major indicators, whether these can be captured and see whether they are driving changes once reflected in the theory, but also reflected in the empirical specifications. It may well be the case that the story of QE could be captured in the excessive money supply growth, could also be captured in the pass-through effects in the exchange rate, but also the shutdown in production, the economic shutdown, could be captured also either in import prices, which could be decomposed into commodity prices, but also could be imported. It could be captured in the price of imported inputs into the production process. And then at the same time, we also captured, of course, prices, which are important in continuing the story, between COVID and where we are now. This represented mainly as a shock, and in terms especially of oil prices. Now, at the time of getting at this presentation, we're thinking as to whether we could capture the observations in the UK, EU, and the US in terms of the major indicators, so that these major indicators are cutting across all the regions of the world, but this is not yet complete. Now, of course, given that although the theoretical modeling is complete, the econometric investigation has already started, and the observations of the indicators, tracking the major indicators, and the changes in these major indicators on a monthly basis, that's already captured and reflected here, a any observations, simple tentative observations, rather than a simple conclusion. We can only hazard guesses in terms of, what in a central bank should be thinking of. The first one is basically that the behavior of inflation targets had the experience of inflation targets, which are frameworks and tools that most developing countries already have in place. Okay, that almost every developed country in the world had tools to work with, especially developing countries, tools to be able to were already in place for inflation targets. That could be a consideration of whether the return to inflation targets would be timely and ideal, okay, and whether these inflation targets, for example, initially aimed at 2%, which is now, of course, low compared to some of the indicators of monthly changes in inflation, across the globe. Whether this, formally instituted and then looked at both for short-run management, but also, as a long-term goal. Having said that, the reason why we put it with a bit of a question mark is the realization that it's not only the upsurge in money growth that could be easily captured through inflation targets. There is the supply side component of it, and to what extent a production in industry and constraints in the labor market are going to be put in place. So that supply component means that inflation targets alone may not be adequate. There is a need for looking at the supply side and to see, whether production will be in place. And but this, this is inflation targets with a caveat that it may not be able to capture the supply side. So what would be important is to watch the exchange rate dynamics during this particular period, in the sense that for these developing countries, exports and imports are typically priced in foreign currencies. And with the dominant global role of the US dollar pricing, short-term exchange rate volatility will much more be pronounced and pass through on inflation outcomes in developing countries. And one of the indicators actually was to see whether the exchange pass-through estimate for every 3 months, how much it has changed since 2021. But we didn't have complete figures to include this, but we'll be including that in the paper. Simple dispersion of the exchange rate pass-through indicators on a 3-month rolling cycle. So that's therefore a quarterly basis of the exchange rate pass-through. And the third is also to consider some of the counter-cyclical measures to dampen inflation expectations and commodity price cycles. Expectations take a little bit time to form, and I think that the dampening of expectation will be an important part of the process, especially weather agents. That means the private sector agents and households are forming the expectations, adaptively or rationally, and therefore could lead to way of dampening the expectations of continued higher prices. But since some of the developing countries are more exposed to the global financial system than others, and they do have little capacity of being able to stimulate the supply side, that becomes an important consideration to think of counter-cyclical measures and how this could be put in place in a short time. So, as I said, this is work in progress. It will start a conversation and to try to see what researchers, policymakers are making of the responses that started with the COVID-19, especially the quantitative easing, the upsurge in money growth globally. I mean, there were packages responded to COVID-19 at the global level, but of course we see the packages were more pronounced in the US, the EU, and the UK. And then, of course, the resultant upsurge in money growth. And of course, the fact that all indicators for prices in many countries of the world and across the regions show that the price changes are on the increase, and therefore the fire of inflation is beginning to come and see whether there's the dynamics of are showing steady increase, whether the inflationary inertia has actually taken root, and then we can be able to the way forward with this paper to be able to have a much more tractable empirical analysis that shows the heterogeneity in the nature of the transmission mechanism from QE prices, but also the heterogeneity in the experience. And that's why we took a little bit of time to explain what are the observations of the key indicators at the regional level. And if the coefficients of the main drivers for the new changes in inflation, if these are stable, that means we can actually do forecasts. We didn't go straight into forecast because you cannot forecast with a stable model unless you are using simple autoregressive measures. But I think that in this case, autoregressive measures will possibly only capture the inertia of inflation. To be able to have the structural element, because we think that the changes in prices are structural. They are structural in the sense that they include not only the traditional money supply, but also they include the supply side. And therefore, to be able to do some serious forecasting, we need stability in the parameters that we can generate that encompass both the money growth and the supply side. And so estimation is our way next, this is where we're going in terms of where we're pointing to. And secondly, the forecasting the inflationary changes that will occur, across most economies in the world. And that is where we are going next. Okay, I think I will stop here and then take observations, comments, questions, so forth. Okay. So I don't know whether Athina is here, a great co-author and who has worked on all these numbers, getting the indicators. And I'm particularly interested to see whether colleagues can make observations on indicators that might be absolutely promising, but which we have not been able to capture, either in theory or in terms of the indicators we have captured, we have included in the regional observations. So I will go to thanks. I can see Bo, I can see Stephanie. Okay, let me start. I think Bo was first in that order. So Bo, please go ahead.
So IMF started to warn for food prices already in 2019 before COVID, and it was seen as a threat then to inflation in developing countries, since food prices are so important. And often then there are specific food prices and also commodities that are more important than others in specific countries. But the thing here about inflation is that, first of all, price levels would rise when basic cost of living go up, food and energy prices go up, and you will have a reduction in your welfare. There is a transition period here, around 9 to perhaps 18 months, when prices adjust. And after that, if you have a successful central bank, you will be able to come down to your target level inflation again. However, many of these developing countries have very different central banks and monetary markets. Some are more developed than others, Others are still quite rudimentary, I would say. So there might be a big difference there. And some countries are doing quite well then with, say, inflation targeting. The thing about inflation targeting is that it will reduce how much you need to raise interest rates and suppress the economy. You can always get inflation down by cutting down the government deficits, raising interest rates, and really press down the economy. The idea behind inflation targeting is that you shouldn't be able to squeeze down the economy so much. And under normal circumstances, you should be able to control inflation quite well then, as long as you keep your government deficit under control and not pump up too much money. So that's the whole idea about inflation targeting. And many African countries are actually on a good way to implement inflation targeting. Not perhaps a full-fledged inflation targeting, but some soft version of it, because it will actually improve the efficiency of monetary policy and control inflation. Then when it comes to the supply side, I find many developing countries think that the supply side is very important. Yes, it is important in the sense that in the transition period, you might want to substitute from different goods to another, and you want new sectors of the economy to grow. And that's of course difficult if you restrict your economy too much. But it's not really a solution to the inflation problem. It's more like what is the temporary effect and the length of the transition period. So looking at supply side is important, but it doesn't really solve the inflation problem, which often is about, the government budget and pumping up too much money that you don't really control well. So you can see that, Sudan now has inflation of 270% something, and they have quadrupled the money supply in 2 years, of course. There are big problems there in controlling the government budget and spending, and also have effective measures there for controlling the money supply, because both the velocity and the supply function turns out to be quite more elastic today than they were, say, 20, 30 years ago. So you need to have more sophisticated instruments in the monetary market to control inflation. So typically it's a matter of increasing the central bank's ability to influence interest rate, control the money supply, and controlling the government budget. So that's what I have to say here.
Thank you very much, Bo. These absolutely useful comments. First of all, starting with the observation on different on food prices and the heterogeneity of different types of food, food prices that one would need to capture, and you're absolutely right, because some of the food prices have been, I think, in the literature in the last, say, 5 years, you see where food prices are going up because foods are being diverted to not consumption, but for example, in the generation of energy and others. The transition period point you mentioned is very, very, very important, and maybe that's what developing countries' central banks should be thinking of, what they need to do in a transition period. And I also agree with the observation on inflation targeting as, in a way, an interest rate as a tool to avoid raising interest rates. Very good comments. And I think, yes, the sophistication of the arsenal of tools that central banks can use, there are very sharp differences in the regions we have mentioned. Thank you very much for these comments. Stephanie.
Thank you very much. I think the research you're doing is really important, and I'm here more to learn. So I'm just a budding central banker. I'm about to start my job. I have some observations also first on the data, and starting from Chile, which I know well. There are sometimes additional mechanisms, also particularly in COVID times, which led to an increase in aggregate demand. In the specific case of Chile, there was a sort of rather eccentric peculiarity that people were allowed to withdraw from their individual pension fund accounts, and that was as important as the increase in government spending. And I think in other countries, there may have been other mechanisms through government guarantees or development banks that could have worked. So you may need to, if you can, add other demand shocks just beyond the increase in fiscal spending, which is, of course, the key one. And there's also interesting mechanisms, I think, that you may want to think about. I think Chile, but possibly also Brazil, has an automatic indexation mechanism because they've had a lot of inflation in the past. In Chile, it's called the UF, Unidad de Fomento. It means that a lot of the prices in the economy are automatically indexed to inflation. Some wages, rents, a number of also interest accounts on savings in banks. And that, of course, is good in the sense that it protects people from inflation, but it does increase inflationary expectations and what is called inflation inertia. So that may be, I think, quite an interesting area to go into, how inflation can be transmitted. In terms of the EU, there were not just the countries had a response to COVID, although that was the main one, but there was also a very large package in the EU of 750 billion that was approved last year, and that contributed particularly to the countries that had been hit especially badly, both in the financial crisis and particularly in the COVID crisis. So that would be, I think, perhaps interesting to add that amount, and also how it was distributed, with countries like Italy and Spain gaining a lot. So I thought that might be useful. And although it's more recent, I think you might want, when you talk about the supply side, I wonder how you could introduce China and the problems that have originated in China or in Asia in general on the supply side, but that have now, at this moment, of course, accelerating because of COVID in China. But even before, I think the impact on costs of transport have become very important in the international transmission. And I think all the variables that you discuss in the policy responses are very interesting. And this is completely off the record because as a central banker, I shouldn't say that. I am a little bit skeptical about the value of inflation targeting. So, because I think central banks have had it a little bit easy, because the introduction of inflation targeting coincided with, the doubling of the world labor supply when China entered the world economy, and so that made goods cheaper. So although I think inflation targeting does have an important role, and I agree with Bo, I wonder whether it's so great. I mean, I think the test is now. And of course, I hope it does work in anchoring expectations. But I think we have to be a little bit careful because it has really not been tested up to now. And I also wonder whether, when you have more evidence, whether you could maybe comment, as you mentioned, on the possibility of doing other counter-cyclical policies that could support the policies like interest rate and fiscal contraction that developing countries will have to follow, like counter-cyclical policies on financial regulation to discourage excessive credit lending to certain sectors, or encourage crucial lending to moderate the impact if it's necessary for credit creation as a new channel to encourage inflation. Although it may be necessary, on the other hand, to encourage domestic credit growth. I wasn't sure in the model, but maybe I didn't look carefully enough, whether you have a channel of domestic credit, which of course was dampened in during COVID, but may be useful to follow. Thank you very much.
Thank you. Indeed, Stephanie, as usual, very brilliant observations and comments, and very good that also you commented on Chile, and I say, good luck with your new role. There are many important contributions you've made in terms of the comments that you shared. I think one important factor which was not on our radar when Athina and I were working on this was, of course, the old problem of automatic indexation. It's a very important point in explaining any inflationary simply because although we are tracking the developments since the outbreak of COVID in March 2020, we should bear in mind that not all countries were on the same starting point. And indeed, the countries that were already implementing very tight, automatic indexation rules in place, okay, would then have, would have experienced a different outfit altogether, because basically, when inflation started coming up, as in has now globally, the indexation was already in place, and we rebuilt some excessive maybe inertia, but of course, it will also increase the inflation expectations that we described in the paper. Yeah, it's also good that you actually questioned the inflation targeting scenario, and maybe this will be an opportunity for us to put it to another rigorous test. Yes. Domestic credit is a very important component, and we can test domestic credit variable as as opposed to excessive money supply growth, because also that, of course, gives its own story in terms of how the domestic credit file will. We're just only starting that some of these QE funding, depending on different countries, may have found their way in expanding the domestic credit, and therefore it's a very important, legitimate point that we try to explore. First of all, just univariate properties of the domestic credit variable since the outbreak, and based on those univariate properties, we can be able to integrate it in the story for the countries we're investigating. Thank you very much. Very, very useful observation. And there are suggestions, of course, on considering other counter-cyclical policies that would discourage excess lending or excess fiscal or impose fiscal discipline. The discipline could not be imposed COVID-19 because those were rescue packages. But post-COVID-19, I think the discipline has come back. And which way? And then that would be some of these counter-cyclical policies that would reintroduce the discipline that most countries had already put in place. Yeah, thank you very much. That's very, very useful. Okay, I can see comments. I can see hand up from yes, Adenawo Shenuga. Yes, yeah. I think Adenawo, you were possibly present in some of these discussions at the Bank of England and your department, and on some of these fears for inflation. Please go ahead. Adenawo Shenuga. Yeah.
Good afternoon.
Good afternoon to you.
Yeah, thank you very much for the presentation. It was quite insightful. However, what I've noticed is the paper didn't look at the asset price channel, and I think it's actually quite interesting what we saw during the COVID crisis. Because really, if you look at Africa as a whole, the markets are not that big or deep enough, to affect inflation compared to, the developed countries. But again, during the COVID crisis, we saw lots of funds, money going into, the non-traditional asset classes, like the Bitcoins and, all those, other forms of assets which are not traditional. So I think it would be interesting to look at that channel, because for me as a monetarist, I believe that inflation is always and everywhere, a monetary phenomenon, calling up on what Milton Friedman actually talked about money supply. And again, both talked about, when he made his comment, he talked about the fiscal deficit budget by most developing countries. And I think if we really want to, track down inflation, for developing countries, we really need to look at where, the flow of, of money. So I think the paper should look at, the asset price channel, in inflation. And I think what we saw during the COVID crisis was quite interesting, particularly, with the huge sum of investment that went into the non-traditional asset classes. Thank you.
I thank you, Adenowo, and thank you for introducing the discussion on the asset price channel. Yes, the fact that we didn't really capture the indicators for asset growth during that period when we are looking at the, take excursion into the regional developments since the outbreak. We should not only because of the composition of assets, the transformation of this composition during the COVID-19, but also because of new asset classes, fintech, you're mentioning some of the fintech products. And I think that's very useful to do. And then to see how these assets or even financial innovations could be brought into the story. If the univariate, the indicators, or the behavior of the invariant indicators, of each invariant indicator seems to suggest that they are important or they have phenomenally changed in this particular period. So that's welcome. Now, as I know that you in the school of the looking at the money influence and also in terms of the monetary aggregate. Yes, and yes, that's why it's captured in terms of the initial. It's like a slide 2 and slide 3 and slide 4 and slide 5, where we had the QE magnitudes, and then we are looking at monetary aggregates, specifically the M2 are shooting up. I know from where you're coming, and I know that you also question, of course, the differences between M2 and M3, whereby you are looking at, say, even M0 and M3, whereby you are looking at, the simplest monetary aggregate per se, exactly, compared to bank balances, the domestic credit that that Stephanie was mentioning, that the bank balances are captured in a M3. Yeah, it's very important, but we could not avoid going over the traditional money growth, Freeman contention, because as we started the story, we are looking at the shutdown, the economic shutdown, the foreign production, all the three elements of the production function we start with in this paper were affected in terms of the labor market, in terms of imported inputs, in terms of financing of working capital. All these were affected, and therefore we think the supply side has some explanation to do. having said that, we subject it to empirical test, and it may well be the case that Sonoga's contention with the money growth is the predominant influence, or it may well be that the supply side story is critically important. So this will be, as we further develop the econometric testing, we can see. But thank you very much for those observations and comments.
Thank you very much, sir. Thank you for that.
Okay, I think what I have possibly legacy hands from Bo, from Adeno, and from Stephanie. So I would like to go into the chat. I don't see any comments in the chat. Aisha, yes, and then I also see whether Athina would like to make an observations in case there is part of the any stones I have not been able to unturn. Has any stone been unturned? Okay, now I go to Aisha.
Yes, thank you, Prof. And Athina, it was a very inspiring presentation and a very trendy topic. I have very little comment. Maybe I missed out during your presentation. Did you take into account supply chain distractions while analyzing why most central banks are inefficient in their inflation targeting? Because supply chain distractions are one of the major issues which triggered the overall prices in the world.
Yeah, thanks very much. You know, you didn't miss it. I think you are, as usual, always polite and yes. We didn't capture this, and it's very much useful to see how these arrangements indeed were affected by COVID-19. Absolutely, yeah. We're so when we're doing this search for current indicators, it's possible we could have done this using Kemi Ekini's techniques of looking at the statements made by central bank governors in their response to this upsurge in money growth or the scare for inflation. Yeah, but we didn't, and maybe we could have been able to see how much central banks are putting faith in inflation targeting, but also how some of the supply chains may have been affected. We didn't, but that's an indicator we could put in, and would do, if plausible, would produce a lot of excitement in understanding the current developments in quantitative easing, in money growth, and the scale of inflation post-COVID outbreak in March 2020. So thank you very much for bringing a new consideration that we can take into account. Thank you.
Thank you, Prof. Thank you.
Okay. Let me see. We have a number of many central bankers in the audience, and maybe some of them will give me further comment, or please feel free to send us, myself and Athina, further comments when you are able, and when the paper is completed, we shall of course circulate it to the group for further comments. Yeah, now I see another hand up by Jaideep. Please go ahead.
Hi, Victor. Thank you for this presentation. It was super interesting. I'm not sure I get everything because it's not exactly like sort of I don't fully know all the stuff that you talked about, but I was just thinking if there's something that you might be said using the same analysis about what happens when the reverse takes place. So, for example, when the when everyone starts tightening in response to inflation, what could you say about that scenario using the same approach that you've developed for this? And
yeah, Jaideep, I think that's absolutely helpful comments. And the reason why it's helpful is that in the past experiences of inflation, we had almost like a chain reaction whereby central banks react in one way and the other central banks follow suit, in the sense that or the realization that prices are going up rapidly. The stability of the value of currency is under threat. And also, of course, the stability in the value of financial assets, the real value of financial assets under threat, because the nominal value is changing very fast against inflation. And so there would be tightening. And in a way, if this is done, this, of course, that will mean that it can aggravate a global recession and increase the stagflationary prediction that we had in that theoretical diagram of aggregate demand, aggregate supply, and the external sector, in this case, the exchange rate. So absolutely, spot on. Actually, that's a very observation. If we find similar changes in the indicators, I think it's an observation worthwhile to making the conclusion of the implications of what you are getting. I guess the implications is basically a monetary policy coordination to avoid this problem. Thank you very much.
Thanks, Victor.
Okay. I don't know whether you have anything to add, Athina, or want to say something as before we close, or let me see whether anything in the chat. No, I don't see anything in the chat.
I don't see anything in the chat, Victor.
Okay. Thanks.
I think you covered me in almost all of the observations that you made. I just wanted to say a big thank you to the participants, and of course, this is why it's so important to put your work out there, even though you're at the beginning of a new idea. But I think that the participants pointed us towards new ideas, for example, the transition period that it's been mentioned, or some country-specific demand shocks, like in the case of Chile, or the argument around questioning inflation targeting, the asset price channel, and the current rise in investment into non-traditional assets. And also a comment on what Isa correctly said. I mean, when we were thinking about this idea and trying to pin down the main contribution of the rise in inflation today was the quantitative easing because of COVID. But of course, after that, other things followed. So the Russian-UK conflict, the Shanghai situation right now. So I think also Isa made a very good point. Yes, just let me say a big thank you to all the participants.
Thank you, Athina, for adding those observations. And I think that's one kind of caveat we need to add to the story, that basically the Russian-Ukraine conflict, we can't capture it into the, but is indeed a very important shock. And we're, of course, the energy price factor, the energy price variable, will capture both. we'll capture both effects, the effect of COVID-19, and then of course the accelerating of the conflict and the impact on energy prices. So that's something that we can capture. So, once again, let me add to Athina's a vote of thanks to all of you, and thank you indeed. As I said, we'll acknowledge all your contributions, and when the paper is ready, we'll share it for further comment and further exposure. Thank you very much, and we look forward to seeing you again on Wednesday next week, same time. Thank you indeed. So let me give a hand of applause to all of you for. Thank you.